Hey guys, it's Sasha. The S&P 500 has been falling for 5 weeks in a row after the stock market opened this morning, down almost 1%. It is Options Friday, so it probably will go up or down 3% from here. We'll see. But the reason that the stock market is feeling gloomy, continuing to feel gloomy, is that new data is now suggesting that the US economy might be walking into a recession. Last night, Nike announced their results after markets closed, and third quarter revenues were $11.3 billion, down 9% on a reported basis compared to the prior year. That's a pretty substantial drop, and Nike's forecast for the second quarter is that things are going to get worse and revenues will fall by over 10%. Looking at past data, this is the worst quarter for Nike since Q3 2022. That's exactly 3 years ago. Now, there may be commercial reasons why Nike is not performing. I'm not young enough to know if it's trendy or not. But on the earnings call, Matthew Friend, their CFO, said, "We are also navigating through several external factors that create uncertainty in the current operating environment, including geopolitical dynamics, new tariffs, volatile foreign exchange rates, and tax regulations, as well as the impact of this uncertainty and other macro factors on consumer confidence." And we're beginning to hear more and more companies on these earnings calls say that the trading uncertainty is making it very difficult to do business. Make it very difficult to do business within the United States, do business with partners, with suppliers, with other countries, with places that are based in countries that the US tariffs are not favoring. When Nike is importing the next batch of their products from China or Mexico, where they have factories, they don't know if the products are going to get hit with a tariff. Maybe it will, maybe it won't. Depends on what's happening. Maybe if they do get hit with a tariff, will it be 10%, 20%, 50%? Depends on which day of the week it is and how people are feeling in the White House. Major policies affecting major investment by big companies, affecting trade, are changing so often that nobody is quite sure what the actual long-term policy is. The Federal Reserve met earlier this week, and they left the interest rate in the US unchanged largely because they are unsure as to what's going on. At this meeting, the Fed is now expecting the US economy to grow more slowly than in their previous forecast as a result of what's been happening. US GDP is now going to grow 1.7% this year, according to the FOMC, compared to a forecast of 2.1% back in December. Interestingly, despite downgrading the economy and upgrading the inflation forecast, the Fed hasn't changed its forecast on interest rates. The median rate is exactly the same as in the December dot plot, and the distribution is now a little bit more compact. So the Fed are now agreed that they are going to have to wait with interest rate cuts, and there is less difference between the opinions of the different people sitting within the committee. By the way, check out the projection from the Federal Reserve for the funds rate in the longer term. These guys legit were sitting there sipping champagne and caviar, and they could not be bothered to make an actual projection, so they drew a stickman. I mean, kudos to them. Credit where credit's due. A great use of the two-day meeting. Now, the CME FedWatch tool saying that the market is now expecting that rates will not change at the next meeting in May, with the next rate cut expected at the June meeting at the earliest. The Atlanta Fed GDP Now tracker is saying that the US economy is going to contract 1.8% in Q1 in their most recent update on Tuesday. And you can see on their chart that the blue bit is beginning to come down. The blue bit is the expectation of where the economy is going from the big companies. So the big companies in the United States are now beginning to vocalize their concerns that the data is indicating that GDP growth is weakening. And if we do see a big decline in GDP in Q1 and the jobs data does continue to look bad, maybe the Fed are going to have to start reducing, their forecasts and interest rates a lot more quickly than the market expects. We'll have to wait and see on that one. Although at the meeting this week, Jerome Powell did say that the Fed doesn't want to move ahead of the economy. He said, "We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity." I mean, the Fed's entire point is to try to manage the economy, and part of that is by looking at the data and being proactive to stop bad things happening, right? Reacting after shit happens makes absolutely no sense. You know what does make sense? Buying stocks on eToro, who are the sponsors of today's video. eToro is a super popular investing app all over the world. And did you know that you can buy stocks on eToro completely for free? If you are based in the UK, for example, you can deposit pounds into your account and you can buy UK stocks, including ETFs priced in pounds, without paying any transaction fees at all. So if you invest in the S&P 500 ETF, you can do that with no commission and no foreign exchange fees on eToro. If you want to buy US stocks, you can convert your money into dollars for a one-off fee of just 0.75%. After doing that, you can keep your money in dollars for as long as you want, and you can keep buying and selling stocks with no transaction fees. And some people really prefer the design to other investing apps. Maybe you would prefer it as well. Go and check out eToro and see what you think. The link is in the description and in the pinned comment. Now, FedEx stock is also down this morning after they cut their full year forecast for profits again. In December, they already reduced their forecast for the current financial year from an initial range of $20 to $22 per share down to a range of $19 to $20 per share. And just now, they reduced it again to be between $18 and $18.60 a share. Given the current financial year for them is ending in May, these are very big negative revisions given we are about 2 months away from the end of the FedEx financial year. Earlier this week, US retail sales for February came in at plus 0.2%, which was much lower than the Wall Street expectation of plus 0.6%. And this comes on the back of a 1.2% drop in January, which was revised down from the initial report, which said it was a 0.9% drop. If the February numbers revised down by the same amount, that will also register a drop. It's also interesting that many companies that were involved in picking up lucrative government contracts are now saying that Elon Musk and his Doge department are beginning to hurt. This week, Accenture has come out and said that Elon has cancelled so many of their government contracts that it's hitting their revenues. Accenture stock is falling very sharply after this news because they said that about 8% of their global revenue comes from the US government alone. Their global revenue is $67 billion per year. So that means the US government was paying the consultants at Accenture over $5 billion per year for their services. I'm not really sure exactly how much service is required for $5 billion a year. It sounds like a lot. I don't know how much they charge over in the US, probably a lot more than they do here in the UK, but I found this rate card in a recent government project from Accenture in the UK where they charge between £190 and £2,220 per person per day. In US dollars, that's roughly $250 to $3,000 per day, and adjusted for the difference in salaries, well, probably multiply that by 2. And in case you're wondering what the level of expertise is for the cheap $250 per day, well, this expert works under close direction, uses little discretion, has minimal influence, and has a basic generic knowledge appropriate to area of work. Anyway, Accenture is one of 10 consultancy companies that are apparently losing these huge contracts with the US government as part of the Doge cost cutting. And those $5 billion per year really do add up. So aside from what's happening in the macro economy, all of those pressures, there is also some downward pressure on GDP now coming from the US government aggressively cutting the federal budget, because every dollar that the US government does not spend is a dollar less in the GDP total. Last year, the US GDP was around $29 trillion. So if Elon Musk actually goes and cuts the $2 trillion overspend that the US government has in their budget, that would make the US GDP fall by about 7%. I'm not sure that's going to happen, but that would be the impact. And there would be one hell of an unemployment issue where many people previously employed in government jobs might not find it very easy to quickly transition into different work in private companies. And then remember that on April 2nd, not Fool's Day, the next day, in less than 2 weeks, Donald Trump said that he is going to enact a new load of tariffs in response to countries that impose tariffs on the United States. After the US first announced their tariffs, Canada, the EU, China all announced retaliatory tariffs back. Not quite as big as what the US announced, but they did. These are coming in at different points in the next few weeks. The EU just delayed the implementation of theirs by half a month until the middle of April, probably trying to bide a bit of time to see what happens. Donald Trump has nicknamed April 2nd 2nd as Liberation Day, because that's when 25% tariffs on Canada and Mexico will kick in, alongside whatever other tariffs that are yet to be announced. Maybe just like the first time that these tariffs were meant to be going in, there will be frantic last-minute negotiations and the US will cancel the tariffs after they've been in place for a few hours. Maybe these tariffs are going to be here to stay. It is looking like maybe they are here to stay because there is already a discussion underway, apparently, whether income tax in the United States should be abolished below $150,000. And that would be an interesting experiment because that would mean only 7% of people in the United States would have to pay income tax at the federal level. And the slight issue is that the other 93% of Americans currently pay about 1/4 of the total tax bill. So to make that happen and to not increase the budget deficit even further, the tariffs that would have to compensate for this would need to be very substantial. And I think the downsides that super high tariffs would bring, the high inflation, a sharp reduction in productivity, a big drop in trade with other countries, and maybe most importantly, a very big erosion in trust with key trading partners, well, these downsides could maybe have a more significant impact on the economy than the upside of not having to pay federal income tax. Remember, go and check out eTORO, who very kindly sponsored this video. Please go and get the app through my link in the description. Thank you so much for watching, and I'll see you later.